Have you ever seen this happen? A company, a huge company, like Google's parent, Alphabet, comes out with these incredible, record-breaking earnings, and then you look at the stock, and it's dropping. It's one of those moments that makes you just scratch your head and think, wait a minute, what did I miss here? So that's the big question, isn't it? Why would amazing news cause a stock to tank? If you've ever been staring at a chart just totally confused by the market's reaction, you are in exactly the right place. We are going to unpack this whole paradox right now, and I promise it's going to make a lot more sense.
Welcome back to the channel, finance people. If you're just finding me, a hearty welcome from the Josh Ellen Finance crew. I'll be your guide today, so get out your pen and pad and let's break this down. All right, so first things first. Before we get into the drama, we have to appreciate just how good the good news really was for Alphabet. Because we're not talking just good, we're talking absolutely stellar numbers.
So get this. In the fourth quarter of 2025, Alphabet pulled in nearly $114 billion in revenue. That's an 18% jump from the year before. And it didn't just meet what Wall Street expected, it completely blew past their forecasts. That's a huge, undeniable win. And a big part of that story was Google Cloud. The revenue there just exploded, up 48%. That tells you everything you need to know, right? The biggest companies in the world are all in on AI, and they're paying Google big time to build out that future. The demand is just off the charts. And to put a cherry on top, for the first time in their history, Alphabet's full-year revenue crossed $400 billion. Let that sink in for a second. By any and every measure, this was a powerhouse performance. So you'd think champagne corks are popping everywhere, right? Well, maybe not so fast. Because this is where the story gets really interesting. In the middle of all this fantastic news, the stock started to slide. And it all came down to one single number that sent a little shiver down Wall Street's spine and had some investors heading for the door. And that number has a name, capital expenditure, or CapEx for short. Now, before I show you the number, let's just quickly define this. Think of it this way. If you own a little coffee shop, CapEx is the money you spend on a brand new, top-of-the-line espresso machine, or maybe even renting a second location. It's the cash you spend today, hoping to make even more cash tomorrow. Okay, you ready for this? Here's the number that changed the whole conversation. In 2025, Alphabet spent a cool $95 billion on CapEx. A lot of money. But then they announced that for 2026, they are planning to spend up to $185 billion. That's nearly double in 1 year. That wasn't just a surprise. That was a genuine shock to the system for a lot of people. So why is that such a big deal? Well, it's a pretty simple trade-off, really. All that cash they're planning to spend on data centers and new hardware, that's cash that isn't going back to shareholders right now through things like stock buybacks. So investors look at that huge future expense and, they start to get a little nervous. And this puts Wall Street in a tough spot. It's a real dilemma. On one hand, you have a company that's just crushing it, printing money with incredible profits. But on the other hand, that same company is telling you they're about to go on an historic spending spree. So, how do you value that? It's not a $1 million question, it's more like a $185 billion question. Let's use an analogy here. Imagine you own a really successful factory making widgets. You just had your best year ever. Profits are through the roof. Then you announce you're taking a huge chunk of that profit to build a second, state-of-the-art factory with all new robots. Now, some of your investors are going to cheer. They see the future. But other investors might say, whoa, whoa, whoa. What about my dividend? That's a lot of risk. And you know what? Both sides kind of have a point. And that is the exact tug-of-war happening with Alphabet right now. You've got today's performance, which is just outstanding. And then you have tomorrow's spending, which is staggering. The entire market is trying to figure out which of those two things is more important for the stock price today. So what does this all mean for you, the investor? How do you think about this? Okay, we're going to get right into our investor playbook. But hey, before we do, if you're finding this breakdown useful, could you do me a huge favor and hit that like and subscribe button? We're trying to get to 1,000 subscribers. And honestly, every single one of you helps us get there. Thank you. Now, let's talk strategy. All right, here's your playbook. Number one, and this is the big one, don't panic over one piece of news. The business itself is still a beast. Second, you have to understand what this spending is for. This is a massive bet on the future of artificial intelligence. They're building the foundation for the next decade. Third, This means you got to have a long-term view. If you believe in that AI future, then this kind of spending is exactly what you want to see. Fourth, just be ready for some bumps in the road. The market's going to be jumpy about this for a while, so expect some short-term volatility. And finally, number 5, don't put all your AI eggs in one basket. It's always smart to diversify. You know, I saw this quote from a market analyst that really just says it all. Growth stories need to balance spending with returns. It's a tightrope walk. And right now, Alphabet is doing that walk in front of the entire world. So I really want to know what you think. Is this a brilliant long-term move, or is it a reckless spending plan that's going to hurt investors? Let me know what you think down in the comments. I read all of them. Thank you so much for watching. Please share it with someone you love, and I'll see you in our next video. Cheers!